Market breadth also shows a red flag. We have around 47% of the stocks above the 200-day MA, down from 54% from last week. Although we still have around more than 40% of the stocks above the 200-day moving average above the long-term MA, this is also quite a significant change. We only have 35% of the stocks above the 20-day MA. This is not positive compared to last week, down from 55%. This is the percentage of the stocks above the 20-day MA. The green box is oversold zone and the red box is deeply oversold zone. This is where we have the bottom form in April. We want to pay attention to. Also, the green box, that's the oversold zone. Many times, whenever you hit the oversold zone, there will be a attempt to rebound, but not necessarily go straight up. For example, back in 2024, December, oversold here, attempt to rebound, have a test back inside the oversold zone, better rebound, back inside this oversold zone. On Friday, this is a test of the oversold zone, and on Monday, yesterday, we have a rebound. Since the April bottom, we haven't seen a dip below this oversold zone. Most of the time, the MMTW, the percentage is hover at about 40% to 70%. Every time it hit the 40%, it rebound to about 70%, consolidate there. This is the first time that it break below this 40%. Okay, imagine that only 25% of the stocks above the 20-day moving average. That means there are lesser stocks participate in the strong run. And a lot of them could be profit taking. Some of them are extended, consolidation, or it could mean rotate into other sector. Pay attention to some other sector that's about to break out, because this consolidation means that this is a laggard. And once it's breaking out, it could trigger the MMTW and rise up further. So far, this is an oversold condition and is rebound. Most importantly, this is the first breakdown we have seen since April bottom. That is a red flag. Percentage of the stocks above the 200-day moving average. Also, we have the change of character. By far, this is the significant down move compared to the past. This is a change of character. Although it is still above 40%, MMOF, that's the percentage of the stocks above the 150 days moving average. Here is also a change of character. Could be a pullback or correction is about to come, but is not a constructive sign. Just something to watch out for. MMFI, percentage of the stocks above the 50-day MA, also a breakdown. Usually it bounces off 60%. Now we have a breakdown below 60. Market breadth is the first red flag. In terms of the one thing that stands out last week, here is a significant volume, increasing of the volume. We have been emphasizing the direction of the S&P 500. As long as we have only normal volume, we have all these small candles, the direction is likely to go up, grind up until spike of the volume like this. Spike of the volume started on Thursday, and on Friday follow through to the downside. This is classified as a change of character. If we compare to the past, the only thing that is comparable could be here in terms of the progress to the downside, but here is also different. In terms of the volume, this is not as great as the recent sell-off. In terms of the price action, we got a demand tail. In terms of the context, we have a rally here, and then this 2 days action erase this whole chunk of the rally just in 2 days. This is not a good sign. First rally, second rally, and third rally. First and second rally are vibrant, but one thing to take note is the first rally comes with big volume and aggressive demand. Second rally, the candle is smaller than the first rally, and in terms of the volume, slightly lesser. So demand is getting lesser. Third rally, progress to the upside is small. Third rally is only a little, suggesting that momentum is exhausted to the upside. Most importantly, here we have spike of the volume. This is something to watch out for. As long as this minor support level at about 62.40 get supported, still not violated, there's still a chance for S&P 500 to go back up, chop around, and the analog we can refer to will be similar to this. A rally, pullback, also a bullish bar, subsequently chop around for 1 to 2 weeks. That is the best bullish scenario that we can anticipate if the swing low support at 62.40 is not violated. Go back up, chop around, similar to this portion right here. If 62.40 fail to hold, means we have a breakdown. We should see another round of the sell-off back to 6,000 to about 6,100. This Exos line closer to 6,100 is a much more meaningful support level. And we could extend it to about 6,000. S&P 500 has the right to retrace to 6,000, 6,100 without violating the long-term structure. The long-term structure is still up. Here, we still have a structure breaking out, coming back, test the 6,000, 6,100, the zone, and to consolidate from here. Perfectly normal. That really violate the long-term structure. If you are swing trading, a lot of the positions will get trigger the stop loss, or you get stop out with profits with a trailing stop because of the significant sell-off. As long as this level is not violated, we still have a chance to have the S&P 500 to consolidate from here to from 6 to 40 to a high